The trade war between the U.S. and China is creating an unprecedented storm in the global economy. Chinese ports including Shanghai and Guangzhou are facing severe congestion with over 2 million containers stuck, unable to reach their destinations. This disruption is directly hitting U.S. retail industries, but it's merely the beginning of a much larger economic crisis. With Trump's decision to raise tariffs from 25% to 50% on Chinese goods including electronics, pharmaceuticals, and clothing, American consumers are already seeing price increases of 5 to 15% on everyday items. More than $300 million in retail orders have been canceled, and forecasts suggest 45 million U.S. households will feel the financial strain by 2025. Subscribe to our channel now for continuing coverage of how global trade tensions are reshaping our economy and what it means for your wallet. Boeing's billion-dollar setback. The conflict isn't limited to just tariffs and containers. China has retaliated by cutting thousands of Boeing orders and suspending contracts for U.S. aircraft parts. Beijing has instructed its airlines to halt deliveries of Boeing jets and related equipment, costing the American aerospace giant billions in revenue. Boeing now expects a 10% production cut this year alone, with thousands of skilled American workers potentially facing unemployment. Corporate exodus, the real price. Major U.S. companies are scrambling to adapt. General Motors and Apple have begun shifting production away from China to Southeast Asian countries like Vietnam and Indonesia to avoid tariff burdens. This corporate exodus comes at a steep price. GM has already put 14,000 American jobs at risk. When industry giants like Boeing and GM suffer, entire supply chains and communities feel the impact. Recession warnings intensify. Financial experts are sounding alarm bells about a potential global recession. J.P. Morgan and Goldman Sachs have raised recession probability estimates to 60% for this year, without adjustments to current tariff policies. Some analysts warn recession risks could reach 30% by late 2025. The job market stands on shaky ground, with nearly 2 million positions in import-export industries potentially disappearing as supply chains fracture and companies restructure. China's tech independence push. China's response to trade pressures extends beyond conventional retaliation. Following U.S. restrictions on advanced chip-making technology, Beijing has invested over $75 billion to build an independent semiconductor industry. They've recruited 50,000 engineers, many returning from Silicon Valley, and now operate factories with 60 to 70% China-made equipment. Chinese companies like Sakar have developed domestic lithography technology capable of producing chips under 7 nanometers, previously thought impossible without Western equipment. Market ripple effects. This technological independence is reshaping market dynamics. ASML, the Dutch lithography equipment manufacturer, saw revenue plunge 27% in late 2024 as Chinese orders evaporated. China has also begun reducing U.S. government bond holdings and pulling investments from American tech stocks, potentially triggering broader financial market turbulence that could affect everything from mortgage rates to retirement funds. Europe's strategic counterplay. European responses to U.S. trade policies have been equally strategic. Rather than matching tariffs directly, the EU targeted America's most valuable export sector, technology services. For U.S. tech giants, Europe represents a critical market. Meta earned $36 billion from Europe, 23% of global revenue. Google parent Alphabet pulled in over $100 billion. Apple generated $101.3 billion, 26% of total revenue. And Amazon reported $43.4 billion in international sales, primarily European, in Q4 2024 alone. Regulatory warfare over tariffs. Instead of imposing traditional tariffs, Europe has leveraged regulatory power through legislation like GDPR, the EU Data Act, and digital taxes. A 3% tax on total revenue, not just profit, means companies like Google must pay €30 million for every €1 billion earned in Europe regardless of profitability. The EU has also implemented targeted restrictions in AI, electric vehicles, and battery technology, areas where American companies seek future growth. Ford's radical transformation. Individual companies demonstrate how these tensions are forcing radical business transformations. Ford Motor Company recently announced the elimination of 2,000 U.S. manufacturing jobs, moving production of several models including electric vehicles overseas. Building EVs in America now costs 25% more than abroad due to tariff-induced price increases on materials like lithium, which has risen 300% since 2020. Project T3, Survival or Betrayal? Ford's $50 billion Project T3 represents a complete reinvention of its business model. featuring partnerships with BMW for solid-state batteries, automation replacing 90% of assembly work, and direct-to-consumer sales eliminating traditional dealerships. CEO Jim Farley defended these moves with stark pragmatism, asking critics whether they'd prefer losing 2,000 jobs now or 20,000 jobs in 5 years if the company fails to remain competitive. Apple's desperate air bridge. Apple has taken equally dramatic measures, chartering dedicated cargo flights to transport 600 tons of goods, approximately 1.5 million iPhones, from India to the United States to avoid 125% tariffs on Chinese-made electronics. The company is rapidly shifting production capacity from China to India, fundamentally restructuring its global supply chain. Analysts project these changes could increase iPhone prices significantly, potentially pushing the premium iPhone 16 Pro Max from $1,599 to approximately $2,300. Allies reassessing U.S. relations. Even traditional allies are reassessing relationships with the United States. Canada has imposed 25% tariffs on U.S. cars and auto parts not complying with updated trade agreements. Canadian tourism to the U.S. has plummeted 70 to 85%, while a Buy Canada movement gains momentum among consumers. Most significantly, Canada is reconsidering its $19 billion purchase of 88 F-35 fighter jets, planning to acquire only the first 16 while exploring alternative suppliers. Global confidence crisis. This pattern extends beyond North America. Portugal has cancelled plans to purchase F-35 jets, citing concerns about U.S. policies affecting NATO. The European Union has rejected America First trade approaches, contributing to growing international skepticism about U.S. economic leadership. The recent whiplash-inducing reversal of U.S. tariff announcements, firmly declared, then suddenly postponed for 90 days, has only intensified doubts about policy consistency and reliability. The real victims, everyday people. The consequences of these tensions are not abstract economic theories, they directly impact everyday lives through higher prices, job insecurity, and financial anxiety. As global supply chains fragment and companies restructure operations, workers across multiple countries bear the heaviest burden of this economic uncertainty. The fundamental reorganization of international trade relationships currently underway will reshape the global economy for years to come. Whether you're concerned about rising prices, job security, or investment impacts, understanding these complex trade dynamics has never been more important. The economic shifts happening today will determine tomorrow's winners and losers in the global marketplace, and your financial future may depend on staying informed. Subscribe to our channel now for continuing in-depth analysis of global trade tensions and practical strategies to protect your financial well-being in these uncertain times.